Hi, in this lecture, we're going to look at the second method of valuing options under the binomial model, which is portfolio replication approach. So we're still in the binomial model, in the single period binomial model. And within that, we're now approaching the second method, which is the portfolio replication. So before we go into the logic under the replicating portfolio method, we must understand the underlying theme. So if there are two securities or two portfolios, for now, let's assume there are two securities. Let's not get into portfolio. If there are two securities which have the same payoff in future, they must have the same price today. And this is actually the prevention of arbitrage principle. So two securities which have the same payoff meaning future cash flow, future cash inflow. If they have the same future cash inflow at a future point in time, then they must have the same cash outflow meaning the price today, right? And this is the no arbitrage principle. We also discussed this very briefly when I was giving a summary of the put call parity, wherein I said that value of put plus value of share is equal to value of call plus present value of strike price, right? The put call parity is also having the same theme. So now let's take an example. Let's say there are two assets, both have the same underlying characteristics. I'm assuming that everything else is the same, in terms of risk or every other characteristic. Both the securities or both the assets have the same characteristics. Let's say they have the same cash flow at t equal to 1 of $50, right? So what will happen is, let's assume that there are no other intermittent cash flows. That is, there's no other cash flow at t equal to 6 or any time in between. Okay, so assume that this is a zero coupon bond. It's just having a face value which is paid at t equal to 1 of $50. If both the assets have the same payoff of $50 at future, which is t equal to 1, they must have the same price today, provided all the other characteristics are the same. And we've assumed that all the other characteristics are the same, right? So given this, we actually need to have the same price today for both asset A and asset B, or security A and security B. Else there will be arbitrage. Let's see how. Okay, for now I've assumed that asset A is priced at $40 and asset B is priced at $47, right? So $50 standing at t equal to 1 for both asset A and asset B, and asset A I need to pay $40 to acquire it, and asset B I need to pay $47 to acquire it, right? So, but acquiring both asset A and asset B is going to give me the same benefit in future of $50. Okay. So how arbitrage will exist is, I will buy an asset which is cheaper, which is asset A over here. So if I buy asset A, I need to pay $40 today. Agreed? And then I will short sell asset B, which is an overpriced asset. Okay. So the general principle is, you buy an undervalued asset or a cheap asset, and you sell overvalued asset or a costly one, right? So over here, the cheaper asset is asset A because its price is only $40, and the costlier asset or the overpriced asset is asset B, which is priced at 47. So I buy asset A, which means I have a cash outflow of $40, and I short sell asset B. When I short sell, I will basically borrow asset B from someone else. Okay, so I am the borrower of the security. There will also be somebody who's the lender of the security. I borrow the security and I sell it in the market. Okay, so I do not own a security. Obviously to sell any asset, I need to own the asset at the first place, right? Whereas in case of short selling, I'm actually borrowing that asset from a third party who is the lender. He's lending the asset to me and I'm selling the asset in the market. When I sell that asset in the market, I'm raising $47. So technically this $47 is actually a liability for me, because at a future point in time, the person who has actually lent me the security is going to come back asking me for the security, right? For instance, if somebody lends you money, at a future point in time, he will come back to you asking you for the money, right? Over here, he has lent me a security. So at a future point in time, he will come back to me and ask me for the security, right? So this $47 that I've received today, I will have, at a future point in time, I will have to return that to the lender of the security, but I don't have to return $47. I will have to return the share, right? I will have to return the share in future. And so how will I get the share? I will have to later acquire it from the market and then send it back to, and then repay it back to the lender, right? So if you look at it today at t equal to 0, I have received $47 on account of short sale, and I have paid $40 on account of purchase of security A. So the net cash inflow for me today is $7, right? Next, for the sake of simplicity, although there is a time gap of 1 year in between, let's assume that you're not investing the $7 anywhere. It's not a prudent way, but hypothetically, let's assume that you don't invest $7. You're taking it purely in the form of cash, right? I mean, I've just made this assumption, to avoid the complexity of compounding, bringing the interest rate, etc., etc. But the final answer is obviously going to be the same whether you invest that $7 or whether you don't invest that $7. Okay, so here I'm making an assumption that we are not investing the $7, and I'm having that cash in my pocket. I'm keeping that cash of $7 in my pocket for 1 year without doing anything. All right, now let's say we reach t equal to 1. At t equal to 1, both these assets will have a payoff of $50, right? So now I have asset A with me. I will be receiving $50 as face value. Let's say the asset A has matured at t equal to 1. I will be receiving $50 face value with regard to asset A that I'm holding. I will be receiving the $50 from the company directly, right? Because we are assuming this to be a zero coupon bond, which is having a tenure of 1 year. So when we reach maturity, the company pays me the face value, and obviously now I don't have the bond anymore with me. Okay, so I have received $50, and next, ideally, the lender who actually lent me the security should have received rather, not would have, he should have received the $50 if he would have continued to own that asset, right? Now he has lent that asset to me. So ideally, I am supposed to pay him $50, which is nothing but the face value that the company would have paid him had he not lent the security to me. All right. So I have to pay $50, which is the face value of the zero coupon bond, to the lender of asset B. All right. So at t equal to 1, I receive $50 with respect to asset A from the company directly, and I will have to pay $50 to the lender of asset B. Okay, over here, generally when I'm short selling, obviously at a future point in time, I have to return the security back to the lender. But here, the security is actually a zero coupon bond, which has reached its maturity, right? So obviously a zero coupon bond which has reached its maturity will stop trading in the market, right? So I cannot go and purchase the security from the market and give the security back to the lender. So instead, what I would do is I would have to repay him $50, which was the face value of the maturity, which he would have ideally received had he not lent the security back to me, right? So today at t equal to 1, the cash flow for me is actually nil, because I have an outflow of $50, I have an inflow of $50. So the cash outflow for me today is actually nil. The arbitrage profit, if you actually see, is $7, because at t equal to 0, I took no risk, because I bought one asset and I sold a similar asset which has the same characteristics, right? So I've taken zero risk, and I have a cash inflow of $7 at t equal to 0. At t equal to 1, again I have no cash outflow, right? So by making zero investment of my own, I have not made any investment from my money, right? Okay, zero investment basically means I have not taken any money out of my savings or out of my income. At t equal to 0, if you actually see, I did not use any sort of money from my home. All I've done is I've short sold, I've received $47. Out of the $47, I've made $40 of investment, right? That $47 actually was not my hard-earned earnings. It was basically a sort of a borrowing, right? So at t equal to 0, there was virtually no investment. I've taken no risk because I was holding opposite positions. One position I was holding a long one, and the other was a short position. So I was actually not open to any sort of risk. Okay, so no investment, no risk, yet at the final stage at t equal to 1, I have a cash inflow of $7, right? So this is nothing but arbitrage, right? I've made a riskless profit, right? Had I not made the second assumption, or the assumption that is stated in the second point, all that would have changed was the $7 would have probably been $8 at the end of t equal to 1. That would be the only change. So the arbitrage profit, by assuming that I'm not investing my $7 in a bank, actually makes a conservative arbitrage profit. If you ask me, that's the arbitrage profit on the lower side. Okay, because truly speaking, you would not keep the $7 in your pocket. You would actually invest the $7 in a bank account and try to earn interest on that $7 as well. There is one cost that we are actually not considering. The person who lent me the security is not doing any charity, right? I mean, he has lent me the security because he would have thought that I would have given him a return, right? Ideally, in a real world, I would have to give him lending fees, okay, which is in the form of interest for that matter, right? I need to give him rebate or lending fees or interest. All of them mean the same thing, right? So out of the $7, there's also going to be one cost for me, which is nothing but the lending fee. The lending fee obviously might be might be expressed as a percentage of $47, which is the price that the price at which asset B or security B was trading on the date of lending. It's going to be a percentage, maybe let's say 0.5% or something of that sort. So obviously from the $7, I would also have to meet the lending fees as well. So basically I've made two assumptions inherently. One, I've assumed one which is an explicit one, where I've assumed that the $7 is not invested anywhere. And the second assumption that I've made, which I've not written down and which most of them also ignore when they're really calculating arbitrage profit, is the lending fee or the rebate fee that needs to be paid by the borrower of the security, which is me, to the lender of the security, which is the third party, right? So finally, the moral is, if there are two assets, or instead of assets, you can also have portfolios. If there are two portfolios which are having the same cash flow in future or the same cash inflow in future, they must have the same price today. If they do not have the same price, then there will be an arbitrage profit. And that is how that is what we actually saw over here as to how arbitrage profit can be earned. Okay. This is actually is the underlying base or the underlying logic for replicating portfolio. Okay. And this is also the underlying logic for the put call parity equation. So just like how in delta neutral method, we actually had an overview first, and then we went into the details, right? Similarly, here as well, we are going to have an overview of what the replicating portfolio method actually is about, and then we will go into the details. Okay. So in a replicating portfolio, what we are essentially trying to do is we will actually try to create a portfolio using a combination of stock and risk-free borrowing and lending. And we will ensure that this portfolio has the same payoff as that of option at maturity. I will repeat myself. We are going to create a portfolio with using a combination of stock and risk-free lending or borrowing. And we are going to ensure that this portfolio that we create has the same payoff as the option at maturity, right? If you remember our example, the option at maturity had a payoff of either, the call option had a payoff of either 7 at the upper node or 0 at the bottom node. The strike price was 48. At the upper node, the share price was 55, and therefore the call option payoff was $7. At the bottom node, the share price was $45, and therefore the payoff of the call option was 0, because 45 is less than $48, which is the strike price. Okay. And if you actually see, that is the reason it's called as replicating, right? We are trying to replicate the payoff of a call option using a stock and risk-free lending and borrowing. Okay, so that is the reason it's actually called as replicating portfolio, because we are replicating the payoff of a call option or the payoff of a put option. Okay, now if the payoff of this portfolio that we created and the payoff of the option at maturity is going to be equal, right? Which means the payoff of the portfolio that we create at the upper node is going to have a payoff of $7, and at the bottom node is going to have a payoff of $0, which means the payoff of the portfolio is going to be the same as the payoff of the option. If both these, so on one hand we have the replicated portfolio, on the other hand we have a call option. Both of them have the same payoff at t equal to 1, right? Of course, by same payoff I don't mean that the payoff is going to be $7 all the time. I mean, the payoff can either be $7 or $0 based on what the stock price is at t equal to 1, right? Just to avoid any confusion, over here the payoff, we have the current spot price of 45 of 50. It can either go up to 55 or 45. Okay, I'm not saying that we are certain that the share price will be 55 or the share price will be 45. We still are acknowledging that the share price could be either 55 or 45. Okay, so the call option can have either a payoff of $7 or a payoff of $0 based on the how the share price moves at t equal to 6, of course, in our case, not t equal to 1, right? Because we had assumed an option maturity of 6 months. We are going to create a portfolio which will have a payoff of $7 if the share price at t equal to 6 is 55, and the payoff if will be equal to 0 if the share price is equal to $45, right? So we are now creating a portfolio which is going to have the same payoff as that of the call option, but the call option's payoff is again in turn dependent on what the share price is going to be, right? So now if the payoff for this replicating portfolio and the call option is the same in future, the price of this replicating portfolio and the price of option should be the same today. Why? Because that is why we actually saw the underlying theme earlier, right? Two portfolios or two securities which have the same payoff in future should have the same price today. In our case, the payoff of the replicating portfolio will also be 7 or 0, and the payoff of call option is also going to be equal to 7 or 0. If they have the same payoff in future, they're going to have the same price today, right? Which means the price of the replicating portfolio today should be equal to the price of the option, right? And we do not know the price of the option, right? What we are trying to essentially find out through the binomial model is the price of the option, which is nothing but the premium that the holder should pay to the writer, right? So we do not know the price of the option, but we will calculate the price of the portfolio, and we are going to say that since both these have the same payoff in future, the price of the portfolio should be equal to the price of the option so as to avoid any arbitrage profits, right? So the price of the portfolio should be equal to the price of the option, and this price of the option is what the premium should be, is what is equal to the premium that should be paid by the holder of the option to the writer of the option. Okay, again, just to summarize, we're going to create a replicating portfolio, which means that portfolio is going to replicate the payoff of the call option, which means if the share price is 55, this portfolio, like the call option, is going to have a payoff of $7. If the share price at maturity is equal to 45, the portfolio, the replicating portfolio that we create, like the call option, is going to have $0 as a payoff. All right. Once we are able to build that portfolio, since both the option and that portfolio have the same payoff in future, they have to have the same price today. Else there will be arbitrage, right? So to prevent arbitrage, both must have the same price. All right. We do not know the price of the option. That is what we want to calculate, rather, right? But we can calculate the price of this replicating portfolio, and we will say that this replicating portfolio's price should be equal to the price of the option, else there will be arbitrage. And obviously in an ideal world, there should be no arbitrage, right? So the price of the option is going to be equal to the price of the replicating portfolio. From an examination viewpoint, this is not really very important, okay? Because ideally, I mean, I'm talking more from a CA final perspective. The institute has never really come out explicitly saying, calculate the value of an option using replicating portfolio. And when the institute does not specifically say that you have to calculate the price of an option using replicating portfolio, ideally what is used is risk neutral valuation. That's the first preferable method. Or the second method that is preferred is delta hedging. This one is the least preferred. All right. So portfolio replication approach or replicating portfolio approach, you can call it either ways, is actually not the preferred method to solve an examination question from a CA final perspective. Okay. But the reason I'm actually discussing this in great detail is because this is damn useful to interpret the Black-Scholes model, which is otherwise very complicated. You know, I cannot really explain you not only if you ask me, any person who does not have a great in-depth understanding of calculus, it is not possible to explain the Black-Scholes model. You know, I cannot derive the Black-Scholes model for you. Okay, but Black-Scholes model can be exactly interpreted the way we are interpreting replicating portfolio method. Okay, so that is the reason I am stressing very much on the replicating portfolio method. Otherwise, from a CA final examination viewpoint, it's not that important. From a CFA level 2 and FRM part 1 perspective, this is important. There could be questions that could be asked from replicating portfolio method in specific. All right. Now, let's see how a call option can be replicated. You know, intuitively, if I actually, if you give it a thought, a call option is actually similar, buying a call option is actually similar to buying a share, right? I mean, you would have got this thought even without me giving the answer out, but unfortunately I have to, you know, because buying a call, you're going to be bullish on a share. Similarly, buying a share is also going to give you a bullish position, which means you benefit when the share price goes up. Okay. But if you actually, you know, think a little in detail, there are two main differences between buying a call and buying a share. Okay. The core differences are: one, initial payment. The initial payment when you buy an option is going to be very, very small. Whereas for buying a share, you need to pay the whole value of the share, right? Okay, maybe, I mean, I've not really planned this out, but let me just try. I'm going to the NSE site. Let's say I take Reliance Industries, okay? And then I have equity, and then I have derivatives. I'm going into the derivative segment. Let me zoom in. Okay, I think this is a little too much. Yeah. I think this is also too much, but I think better. Yeah. Okay. So I've gone into the derivative segment. The underlying value, which is nothing but the spot price of Reliance. Again, I'm not recording it during active market hours. So this is after the market is closed. It is 2000, let's say 2000 rupees. I'm just rounding it off. Okay. Let me take stock options. I'm taking the expiry date of 26th of November, call option, and I'm taking an at the money call option. Okay, which means I'm taking the strike price of 2000. Okay, the last price, which is nothing but the closing price of this particular call option. This particular call option meaning a call option whose strike price is 2000, which means it's at the money because the share price is also almost close to 2000, whose expiry is on the 26th of November or 2020, and it is a call option. That call option's price is 61.5. All right. So if you actually think, if I want to create a bullish position in Reliance, okay, I expect the share price to go up and I want to benefit out of it. There are two ways of doing it. One, I go to the market, go to the spot market and buy the share of Reliance. Okay, if I want to buy one share of Reliance, I will have to pay 2000 rupees. I will get a Reliance share. Okay, and then if the share price goes up, I will benefit out of it. The second way to actually benefit is I go to futures and options segment and I buy a call option. I buy a call option whose strike price is 2000 rupees. So from here, if the share price of Reliance goes up, again, I will benefit because the call option premium will go up and I will have a positive payoff. All right. There's also a third way. I can go and buy a futures, right? I'm not discussing the third way. I'm now sticking myself only to buying a share and buying a call option. Okay, I have intentionally not discussed on what will happen when the share price falls. Okay, give me a minute and I will come back to that. All right. So basically, we've seen that there are two ways. I can buy a call option and I can also buy a share. Okay, but the main difference is when I buy a share, I will have to invest 2,000 rupees. Okay, whereas when I buy a call option, all I have to invest is 61.5 to benefit from the upside move in Reliance. For a call option, I have to pay 60 rupees, whereas for buying a share, I need to pay 2,000 rupees. It's almost what, maybe 5%. I think 61.5 is approximately about 5%, is it? No, not even 5. It's about 2.5% maybe. Okay, whatever. uh, so what I was trying to say was, the initial investment that is required for buying an option is actually very, very small or very negligible compared to the investment that is required to buy a share. Okay, and that is the first difference. The initial payment for a call option, which requires an upfront payment, is negligible versus a significant payment which is required for buying a share. Diverting exactly for a minute, Ind AS 109, which is part of your financial reporting, or IFRS 9, one of the condition it imposes for calling it to be a derivative, and it gives you three conditions. One is it should derive its value from an underlying variable. That is fine. The second condition that Ind AS 109 actually imposes is there must be negligible upfront payment to call it a derivative. Okay, the initial payment that is required should either be zero or it should be very minimal compared to what you would have paid to actually get exposure in the underlying value. Okay, to get an exposure to the underlying value, you must pay 2,000 rupees for Reliance, okay, to buy a share, but you're able to get the exposure for the underlying just by paying an initial investment which is equal to 61.5. Let's, for the heck of doing, I'm just calculating what 61.5 divided by 2001 is. It's about 3%, which is slightly greater than 2.5%. 2.5% would have been equal to 50 rupees. Okay, so I just have to pay 3% of the actual underlying exposure to get a benefit. To get an exposure of Reliance of worth 2,000, I'm only paying a 3% of it, which is 61.5, to benefit out of it, right? So the initial payment is actually negligible. That is one difference between call option and stock. Buying a call option and buying a stock. In case I buy a future and instead of buying a stock, the initial investment is virtually zero, because for futures I do not have to make any upfront payment except the margin. Margin is not considered to be initial payment because margin is more like a deposit. It's, whereas for a share, when you actually pay 2,000, that 2,000 is not a deposit, it's actual cash outflow, whereas margin is actually your money but lying with someone else, to protect the third party from losses that you may incur in future. Okay, so margin is not supposed to be considered as upfront payment. Give me a second, sorry. Yeah, so the next difference between buying a call option and buying a share is that a call option actually has only a positive payoff or zero, whereas buying a share will not is not the same. In that sense, is not the same exactly as a call option, right? So there are two differences. So firstly, we saw that buying a call option is the same as buying a share. Intuitively also you would get that feeling, because both of them create a bullish position wherein you gain when the share price goes up. But we saw that there are two differences. One, the initial payment is negligible in case of a call option, whereas for buying a share, you actually need to pay the whole share price, right? We saw that the call premium is only about 3%, right, of the underlying share price. The second is where, when I was discussing the example of Reliance, I just mentioned that we benefit when the share price goes up, right? I did not talk about the case where as to what would happen when the share price falls down. A call option is actually only going to give you a positive payoff or zero, right? At the bottom node, it could only be zero maximum, right? At the least, it could only go to is a zero payoff. As a call holder, you would not be required to pay money to the writer on maturity, right? You would either receive some money or you would receive nothing at all. Whereas in case of a share, at t equal to, let's say over here the t was maturity was 26th of November. At 26th of November, the call, okay, let's take this example again. On the 26th of November, the call option will either be a positive number or will be zero. The share, I mean, the payoff for a share price on 26th of November will actually be the share price itself, right? Because let's say I buy a share today worth 2000 rupees. On 26th of November, the share price can go either up or go down. Okay, let's hypothetically assume a U of 1.1, upside factor of 1.1, and D or downside factor of 0.9. Okay, hypothetically. So this 2000, which is today, can have a payoff of can have a future spot price of 2200, or it can have a future spot price of 1800 on 26th of November 2020, right? The payoff of buying a share is actually nothing but either 2200 or 1800, right? Because payoff is nothing but your cash inflow on maturity, right? If your cash inflow on maturity, if you buy a share price today, is going to be the share price as at t equal to 26th of November, on 26th of November, because you can sell that share and receive a cash inflow to that amount, right? So in case of a in case of a call option, the payoff is either positive or is equal to zero, whereas in case of a share, the payoff is actually equal to the future share price itself, right? Which can obviously never be negative. It is also bound by zero, but obviously the call option will start having a zero payoff once the share price closes below the strike price, right? If the share price closes below the strike price of 2000, which in our case we assume that at the bottom node it is 1800. If the share price is 1800 on 26th of November, the call option is going to have a zero payoff, whereas the share will continue to have a positive payoff. The share's payoff is going to be 1800 at the bottom node. Okay. At the upper node, the call option payoff will be 200 and the share payoff will be 2200, right? So if you actually are able to think of it, initial investment, the call option, what you pay is going to be a minuscule amount compared to what you pay for a share. At maturity also, what you receive from as a payoff from share is going to be much higher than what you receive as payoff from a put option, from a call option, sorry, right? From an option in general. So in terms of payoff, a call option only has positive payoff or zero, whereas the payoff for the share price is the spot price at the option maturity, which in our case we assume as either 2200 or 1800, right? And just like how call and put options require insignificant upfront payment, which means the upfront payment is going to be a fraction of the underlying share value. Similarly, the payoff of a call option is also going to be a fraction again of the payoff of the share price, payoff of the share, which is nothing but the spot price as at the option maturity, right? For instance, it was 200 for a call option versus 2200 for a share at the upper node. At the bottom node, it was 0 versus 1800, which was the share price that we assumed at the bottom node. Okay. So obviously, intuitively, although you can think that buying a call is similar to buying a share, there are actual differences, and those differences are in terms of cash flows, right? So in terms of cash flows, buying a call and buying a share are not exactly the same, because buying a share requires a heavy cash outflow today, and it also involves a heavy cash inflow at maturity. At the same time, buying a call option requires a negligible cash outflow at t equal to 0, whereas it could involve a cash inflow or may not involve a cash inflow at all, which means may not involve a cash inflow, meaning zero payoff at maturity. All right. So it is buying a call option is not the same as buying a share. To tackle this problem of difference in cash flows, we look at call option as leveraged stock buying. What do we mean by leveraged stock buying? Leverage basically means borrowing, right? So leverage stock buying means the 2000 rupees that we actually saw in Reliance, do not invest the whole of 2000 rupees from your savings. Instead, borrow a sum of money. I'm not saying borrow the entire 2000, borrow an X amount. Okay, that X amount is obviously going to be less than 2000. Okay, let's say that value is about 1900. Hypothetically, I mean, I've not calculated this at all. Hypothetically, let's say it is 1900. You borrow 1900 and you invest 100 rupees of your own savings. Okay, you've borrowed 1900 from some jack who's ready to lend you some amount of money at an X% interest rate. And then you are using 100 rupees of your own savings. Both of them put together is 2000. You invest this 2000 into the share, into buying a share. Okay, when you invest 2000 in buying a share, what will happen is, irrespective of what the maturity share price is or what the share price on maturity is, you will have to repay the borrowing back to him, right? Okay, so if let's say the share price is 2200, what will happen is you will take 2200, you have to repay 1900 plus some interest. The remaining amount of all, let's say, ignore the interest part of it for now. You'll have to repay 1900 to the lender, and the 300 belongs to you. So if you actually look at it, you have invested 100 rupees of your own and you have brought home back with you 300, right? The reason why you have been able to magnify your return, because you have earned a profit of 200 by investing. 200 is nothing but the difference between 300 and 100. You have earned a profit of 200 by investing 100, right? So you have earned a 200 percentage profit, versus what you would have earned was only 10 percentage had you invested the whole 2000 from your own savings, right? 200 percentage versus 10 percentage. The reason why you were able to magnify your return on investment was because 1900 rupees did not belong to you, right? You borrowed from someone else that 1900 and invested in the share of Reliance, but the profit you have enjoyed entirely. You did not share the profit with him. You did not share the profit with the lender. Okay, this is actually what you actually would have read as financial leverage, right? Financial leverage is nothing but maximizing your profit by usage of debt. Correct? What you have done here is exactly using financial leverage. You've borrowed money and invested that money in the share price. You've magnified your profit. Is this then why doesn't everybody actually raise money and then invest in shares, etc., or invest in your business? The reason is, I have taken the case as to the share price be going up from 2000 to 2200. What if the share price goes down from 2000 to 1800? Is the lender actually going to take the loss of 200? The answer is no. The lender, you will still have to pay him 1900. Okay, so what will happen is, you will have to take another 100 rupees out of your savings. You have received share price of 1800, take 100 rupees additional out of your savings, put that 1900 and give it to the person who has lent you money. Okay, so if you look at it in this way, the initial 100 that you have lost, that you had invested, was also gone. Furthermore, you had to actually take another 100 rupees out of your savings to repay the lender. So your total loss is actually 200 I mean, your loss actually is to look at it, it's actually 100. It's the 100 that you have. Sorry for the confusion in amounts, but it's basically your loss is also magnified, right? I mean, loss, if you look at it as a percentage of initial investment, it's actually 100 percentage, because you have lost 100 on an investment of 100, or rather, you have lost 200 on an investment of 100. So your loss is 200 percentage. Sorry for the confusion. Okay, so your profit could also be 200 percentage, or your loss could also be 200 percentage. Agreed? So this is actually the implication of using leverage when you actually when you borrow and when you invest in business. Not only does the prospect of higher return come into picture, but the prospect of higher risk also comes into picture. Higher risk being nothing but the loss that you could actually incur, right? So if you actually looked at the situation over here, just like how in a call option, the amount that goes in from my savings is very, very minimal. In this case also, the amount that I invested from my savings, which I assumed to be $100 rupees, was minimal. Okay. So buying a call option is similar to borrowing and borrowing an X amount which is less than the spot price. Okay, I'm not saying you borrow the whole of 2000 rupees. Borrow an amount which is less than the spot price, add to that amount some savings of yours, and put the whole amount into share, right? Okay, so buying a call option is similar in that way to borrowing and then investing the amount in a share, right? So when you borrow and buy a share, your own money, which means the money that is going in from your savings, would actually be negligible. And in that sense, it is actually going to be, if you look at it, your initial investment from your own money is actually very, very minimal. And that way, it is actually similar to a call option, wherein the initial investment in a call option is also very, very minimal, right? If you're still in thoughts, let's actually go out and prove it. But I will be doing that as part of the next video because this video is actually getting a little lengthy. So I will be doing that as part of lecture 3, part 2. Thank you guys.